am Belinda Arender, and welcome to this episode of The Brief, where we talk about leadership, lending, and life. Today, we're debunking myths about interest rates. So let's get to the basics. What is an interest rate, and why does it matter? Well, the interest rate is the rate of return that you're paying to get a mortgage. What does that mean? It is the cost of borrowing money. The reason it matters is because the higher the interest rate, the higher your payment, or the more you're paying for that money. The lower the interest rate, the less you're paying for that money. So what are you paying interest on? Chances are you're paying interest on something, whether it's your mortgage, whether it's a car payment, whether it's those pesky credit cards, you're paying interest on something. So let's talk about what drives mortgage interest rates. So many times people think it's just the economy, when in reality, there's a lot more to it. For example, years ago, we could look directly at the 10-year treasury and know what mortgage rates were doing. For a while, we could even use gas prices and know if rates were going up or down. But because we're such a global economy these days, so many more factors go in. And interest rates can be artificially affected. What does that mean? Back during the pandemic, the federal government was buying mortgage-backed securities, which artificially lowered rates. So there's a lot of factors that go into interest rates, not just what's going on in the economy. I also want to talk about the differences in interest rates versus the actual program that you choose for your mortgage, because lowest is not always best. There's adjustable rate mortgages that are going to traditionally be lower than fixed rate mortgages, but they're going to have an adjustment period at some point, meaning the rate's going to change. Also, depending on the loan program you choose, you may have mortgage insurance that on one program is substantially higher than the lower interest rate that you're looking at. So it's not always about the lowest interest rates. Most of the time when people tell me they want the lowest interest rate possible, I always ask, do you want the lowest interest rate possible, or do you want the lowest monthly payment? Because they're not always the same thing. So that's where it's really important that you have conversation with your loan officer to talk through different options and different programs, because lowest isn't always your best. So the house that you want to purchase, there are factors that are going in that are going to determine if you qualify for that house. First and foremost, your income, your debts, the price of the house, the cost of the house, taxes and insurance, as well as the interest rate. So let's break that down. If you make, let's just say you make $5,000 a month, most programs will let us go to around 50% debt to income, including the new home. So if you make $5,000 a month, and we can go up to a 50%, what we call a debt to income, we can have $2,500 in monthly payment and debt. So if you have a $500 car payment, the available amount for your mortgage is around $2,000 a month. $2,000 a month would include taxes, insurance, if you have mortgage insurance, and if there's an HOA on the property. And my job as a lender is to help you know what you qualify for and to talk to you about what you want to afford, because they're not always the same numbers. In that example, you could afford a $2,000 a month payment. You qualify for that. But does your budget allow you to be comfortable with that? That's what we talk through as a lender with our clients. And all of these conversations circle back to what your buying power is, so that when you're out looking for your dream home, you're comfortable that you're going to qualify and afford it within your budget parameters. And that's enough math for today. I am Belinda Arender. This is The Brief. Make sure you're following me on socials. Please subscribe here on my YouTube channel, and I look forward to seeing you next time.